Okay. If you've been keeping an eye on the financial markets recently, well, you've probably noticed some pretty big tremors. We're not just talking stocks here.
No, definitely not. We're seeing huge moves in areas often outside the main spotlight. Things like gold, Bitcoin,
Yeah.
and maybe the biggest one, the US dollar. It's looking a bit shaky.
Yeah, shaky is a good word. In Wall Street, they love a catchy phrase. They're calling this the debasement trade.
That's the one. It's this whole narrative suggesting that maybe, just maybe, you should be thinking about shifting funds away from things tied directly to the U.S. government, like treasury bills.
And moving into what? Gold, assets outside the system.
Exactly. Precious metals, maybe digital assets that aren't controlled by any central bank. That's the core idea.
Right. So our mission today in this deep dive is to sift through our sources and figure out, is this debasement trade just talk, just a narrative, or is it starting to look like, well, reality?
And what does debasement even mean today in the 21st century? It's not like kings are clipping coins anymore.
Good point. And we need to look critically at gold and Bitcoin. Are they genuine hedges against the dollar weakening? Or is this just people chasing the latest hot trend?
Let's ground this first. We need some facts. What are we actually seeing right now? Let's use the data as of, say, October 20th, 2025.
Okay, the numbers are pretty stark. Gold. It's absolutely rocketed. It broke $4,300 an ounce.
Wow. And year over year, what does that look like?
That's a 65% jump in just the past year. 65%.
That's huge. And meanwhile, the dollar, the currency that basically runs global trade.
Yeah, it's struggling. It's weakened about 9% this year against a basket of other major global currencies.
Okay, so gold up massively, dollar down significantly.
Right.
What about Bitcoin, this so-called digital gold?
Bitcoin's also seen a rally, up about 16% this year, so you put it all together.
It definitely looks like the market is pricing in some kind of significant risk, doesn't it? Something related to the dollar's stability.
It certainly seems that way, but before we dive into why this might be happening now, let's clarify that term, debasement. You mentioned coin clipping.
Right. Historically, it was very physical, very tangible. You know, if a king or ruler needed cash, maybe for a war or just lavish spending.
And didn't have it.
Exactly. They'd recall the coins, melt them down, and reissue them, but with less actual silver or gold. They'd mix in cheaper metals, like copper.
I remember reading about Henry VIII's great debasement back in the 1540s. He really went to town on that, didn't he?
Oh, he did. Massively reduced the silver content to fund his military campaigns. It was essentially a way for the government to inflate the money supply secretly, create more money out of thin air, effectively.
But we don't use gold coins anymore. We use fiat currency dollars, euros, yen, backed by, well, trust in the government, right?
Precisely. It's backed by faith and credit, not a physical commodity. So you can't physically clip a digital dollar or a paper note.
So how does debasement work today? How do central banks or governments achieve that same inflationary effect?
The modern equivalent is less direct, but achieves a similar outcome. Instead of messing with the metal content, you dilute the value of the currency unit itself.
How? By printing more money.
Essentially, yes. Through things like quantitative easing money printing or just massive government spending funded by borrowing, you increase the overall supply of money and credit circulating in the economy.
So more dollars chasing the same amount of goods and services, potentially reducing the purchasing power of each dollar.
That's the risk. It still comes down to funding spending by, let's say, expanding the monetary base, which hinges on people maintaining confidence that the government can manage its finances responsibly over the long run.
And we know this fear of dilution isn't exactly new. It pops up periodically.
Oh yeah, we heard a lot about it after the 2008 crisis. Remember, zero interest rates, QE. People were screaming hyperinflation was coming.
And then again, after the huge stimulus packages during the COVID-19 pandemic, same predictions.
Exactly the same. And yet, in both those cases, after some volatility, the dollar eventually stabilized, even strengthened.
Why did it survive then?
Ultimately, confidence, maybe grudging confidence, was restored. And crucially, there wasn't really anywhere else for all that global capital to go. The U.S. markets remained the deepest, most liquid, perceived, safest place.
Okay, so that brings us to now. If this anxiety is cyclical, what makes 2025 feel different? Why are investors globally looking at the situation and thinking, uh-oh, maybe this time it's serious?
I think it's a combination of factors hitting at once. Our sources point to a few key things. Domestically, there's the federal budget deficit.
It's always big, isn't it?
It is, but the concern now is that it seems structurally embedded. It's not just a temporary blip. It looks like a long-term trend, raising real questions about how the U.S. is going to pay its bills down the road.
Okay, so domestic fiscal worries. What else?
Then there's the geopolitical side. There's a perception, right or wrong, of shifting U.S. foreign policy priorities.
Right.
And maybe most significantly, the use of economic tools, particularly tariffs, not just as trade measures, but as central pillars of policy.
And how does that feed into the debasement narrative?
It creates uncertainty. It potentially disrupts global trade flows, makes international partners nervous, and raises questions about the long-term reliability of the dollar system if economic tools are being, let's say, deployed more assertively.
So domestic fiscal issues plus global uncertainty. Is there hard data showing this stress beyond just the gold price?
Yes, and this is where it gets interesting. It's not just hedge funds making bets. We're seeing official players, central banks, making moves.
Which central banks?
Particularly those in emerging markets. They are buying gold at the fastest rate we've seen in decades, stacking it up in their reserves.
Why? Just as an inflation hedge?
It's partly that, but it seems more profound. It looks like insurance. Insurance against geopolitical risk, against potential sanctions, against the possibility of the dollar system being weaponized, as some might put it. They want an asset outside anyone's direct control.
Okay, central bank gold buying is one signal. What else?
The other subtle sign is in the bond market. Foreign holdings of U.S. Treasury bonds, the debt that finances the U.S. government, have actually been declining as a percentage of the total U.S. debt outstanding.
So while the total debt grows, foreign players are holding a smaller slice of the pie.
Exactly. It suggests that some major global holders, maybe governments or sovereign wealth funds, are slowly, quietly diversifying their reserves. It hints at a gradual erosion of confidence in the very long-term fiscal path.
That does sound like compelling evidence for this debasement narrative gaining traction. But as we said, people have predicted the dollar's doom before.
Many, many times.
And our sources also lay out a strong counter-argument. They talk about the dollar's structural defenses. Why might all this fear be, well, overblown?
Right. There's some powerful reasons why the dollar might just shrug this off again. It boils down to maybe 4 key structural advantages the U.S. system still possesses.
Okay, what's the first one?
The first is maybe the simplest, but also the most powerful. T&E still applies, but for currencies, there is no alternative. Not at scale, anyway.
What about the euro or the Chinese yuan? We hear about them challenging the dollar all the time.
We do, but they both have fundamental issues. The Eurozone is huge economically, but it lacks that deep fiscal integration. Shared monetary policy, but not shared taxing and spending power, that creates potential instability.
And the yuan?
The yuan faces different problems. It's still not fully convertible. There are significant capital controls, and the legal and regulatory environment isn't seen as transparent or predictable enough for global reserve managers.
So basically, no other currency market has the sheer size, the depth, the liquidity, and the legal framework of the U.S. markets.
Precisely. Where else are you going to park trillions of dollars reliably and accessibly? The dollar's dominance is partly just the sheer inertia of this massive network. It's the default.
Okay, factor one, no credible alternative at scale. What's number two?
Number 2 is economic performance. Despite the fiscal worries, the U.S. economy generally continues to outperform most other major developed economies.
Why is that?
Several reasons. You've got relatively better demographics compared to, say, aging Europe or Japan. You have a dynamic innovation sector, and critically now, the U.S. seems to be leading in implementing productivity-boosting technologies like AI across industries.
So as long as the U.S. economy is seen as the most dynamic growth engine, demand for dollars to invest in that economy will likely remain strong.
That's the argument. Capital flows to where it expects the best returns and growth prospects.
Okay. The third factor you mentioned is, well, it's a bit controversial, isn't it? Tariffs.
It is controversial from a trade policy perspective, definitely. But if we look at it purely from a fiscal angle, setting aside the trade debates, tariffs do bring in revenue.
How much are we talking about?
Well, the Congressional Budget Office, the CBO, which is
Yeah.
generally seen as impartial, they put out an estimate. They reckon that if the current tariffs stay in place, they could actually reduce the primary deficit by something like $3.3 trillion over the next decade.
Okay, hang on. Define primary deficit for us. What's excluded there?
Good question. The primary deficit is the budget shortfall before you account for interest payments on the national debt.
Ah, so it excludes the cost of servicing the debt we already have, which
Yeah.
is huge and growing fast.
Exactly.
Yeah.
So Tariffs clearly don't solve the whole debt problem, not by a long shot. But that CBO estimate suggests the revenue could make a meaningful dent in the underlying imbalance between spending and non-interest revenue. It acts as a kind of fiscal stabilizer that sometimes gets missed in the broader trade debate.
Interesting point. Okay, and the fourth, structural defense.
This ties back to the first point about inertia. It's the deep, deep dependency of the entire global financial system on the dollar.
How so?
Think about it. Global trade is overwhelmingly invoiced in dollars. Major commodities, especially oil, priced in dollars. International loans and bonds, mostly dollar-denominated.
It's the plumbing of the system.
It is the plumbing. To rip out that plumbing and replace it with something else, euros, yuan, whatever, would involve absolutely massive, almost prohibitive switching costs for every single bank, corporation, and government on the planet.
So even if countries want to move away from the dollar, the practical difficulty and cost of doing so create this enormous built-in stability.
That's the idea. This network effect is incredibly sticky. It creates a powerful inertia that even large domestic deficits find hard to overcome quickly.
Okay, so the dollar has some pretty formidable defenses. Let's pivot back to the hedges people are supposedly rushing into, starting with gold. Up 65% in a year. Is that a smart place to be now?
Gold is interesting. It has this dual role, right? Central banks hold it in their reserves, giving it a kind of official monetary status, but it's also a sentimental asset. People buy it because they believe it's a store of value.
But you can't buy groceries with it.
Exactly. Its practical use in commerce is zero. Its value relies entirely on that shared belief in its historical role. For gold to keep climbing at this pace, you'd need markets to genuinely believe that the dollar's role as the world's reserve currency is truly ending.
Which would imply.
Yeah.
What? A complete breakdown.
Pretty much. A fundamental collapse of confidence in U.S. institutions, or a massive disruption to global trade that forces a system change. We haven't really seen that yet.
And this is where we need to insert a serious note of caution for you, the listener. Our sources strongly warn against chasing this kind of momentum.
Absolutely. Buying an asset after it's already shot up 65% in a year, that's classic performance chasing, and it's often when strategies like that become extremely dangerous. The risk of a sharp pullback is very high.
So gold might be useful insurance against a true catastrophe.
Yes, insurance is a good word, but it likely needs that catastrophe scenario to play out, or at least seem imminent, to justify these kinds of price levels continuing upwards indefinitely. It's a bet on instability, not necessarily on productive growth.
Okay, let's turn to the other big one, Bitcoin. Pitched as digital gold, the ultimate decentralized escape from potential dollar debasement. Does the data actually back that up?
Well, the narrative is certainly strong. And Bitcoin does have some genuine tailwinds, things like the new ETFs bringing in institutional money, growing regulatory clarity in some places, and its core design feature, scarcity. There's only ever going to be 21 million Bitcoin.
But does it act like gold? Does it act like a hedge?
That's where the story gets complicated. When you look at the data, specifically correlation data.
How closely does it move with other assets?
Exactly. Bitcoin's price movements still tend to be highly correlated with traditional risk assets, especially equities like the S&P 500.
And that correlation number is quite high sometimes, isn't it?
It really is. Our sources show that at times the correlation between Bitcoin and the S&P 500 has gone above 0.9.
Wow. So 1.0 would be moving in perfect lockstep. 0.9 is very close. Why is that significant if you're claiming to be a hedge?
Because a true hedge, like gold often is, should ideally move independently of risk assets, or even inversely. Gold's correlation to equities is often near zero. But when Bitcoin moves so closely with stocks,
it means when investors feel good and buy stocks, they also buy Bitcoin. And when they get scared and sell stocks, they sell Bitcoin too.
That's largely what the data suggests, yes. It behaves much more like a leveraged bet on risk appetite, a sort of tech stock on steroids, rather than a safe harbor from risk or monetary debasement.
So despite the digital gold narrative, its actual market behavior looks more like a risk-on asset.
For now, largely yes. That could change in the future, but based on the current correlations, it's not consistently acting as that independent hedge against dollar weakness or inflation the way gold sometimes does.
Okay, that brings us towards wrapping this up. Let's synthesize. This debasement trade narrative is everywhere. Is it a fundamental shift we should all be preparing for, or is it maybe just the latest market buzzword?
It's crucial to have historical perspective here. Financial markets love a good narrative, a catchy theme. They often stick names on trends that feel permanent at the time.
Can you give some examples?
Sure. Remember, Tina, there is no alternative, which basically argued you had to buy stocks because bond yields were so low. Or
Yes.
the great rotation that was supposedly happening out of bonds and into stocks. Or even going back further, the rather unkind acronym PIGS, used for Portugal, Italy, Greece, and Spain during the Eurozone debt crisis.
Right. These labels capture the mood of the moment.
They capture the mood, exactly. But the underlying dynamics often prove more complex or transient than the label suggests. And as we've discussed, the dollar's demise has been predicted many, many times before. The 70s inflation, 2008, COVID.
And it's still standing.
It's still the default. So, while the reports of its death might be exaggerated again, the structural advantages, the deep liquid markets, the lack of a real alternative, the system's inertia, these things are powerful counterweights to the current anxieties.
So the debasement concerns reflect real fiscal worries, absolutely. But they're running up against this massive, entrenched global structure that's very hard to change quickly.
Which leads us, I think, to the final thought we want to leave you, the listener, with. It's
Yeah.
something to mull over.
Okay, what is it?
Given everything we've talked about, the dollar's structural defenses, the
Yeah.
huge network effects, the massive switching costs, and the fact that domestic deficits alone haven't been enough to dethrone it in the past.
Right.
What specific kind of event, what fundamental breakdown in global trade or institutions, something truly systemic and global beyond just U.S. fiscal policy would actually have to happen to genuinely trigger the end of the dollar's supremacy? That's the multi-trillion-dollar question, isn't it? What did that threshold event actually look like?